Welcome to the 7 ways to lose money with bonds. And in this video, you are going to learn about 7 different ways that people just like you, different investors, can lose money, in some cases all of their investment, with bonds. Now, and also stay tuned to the very end. I'm going to give you a link where you can go get a free report and download it instantly to get a free report on this that we created around this 7 different ways to lose money with bonds. All right, so let's get into it. And so for the last few decades, bonds have really been perceived as the very low risk asset class that's always played very well in any kind of portfolio, with its riskier stepsister called stocks. And bonds have remained very popular over the years because they're able to create steady streams of cash flow, and they are viewed as incredibly safe instruments, of course with the exception of some junk bonds and things like that. But they've always been viewed as a very solid balance to many investment portfolios. And although investors across the country have certainly lost money in bonds at different periods throughout the years, today's perfect storm, in our opinion, with this interest rate environment, is really setting up a perfect storm that could possibly be the biggest bond bubble in history. And this is why it's so important that you watch this entire video and learn about all the different ways that you can lose money with this. Because sadly, most of the average investors out there have absolutely no clue about the risk involved with their bond holdings. And in any one of these bond risks that we outline below in this video could be very, very costly for you. And moreover, when a few of the risks combine together at one time, which is very possible and plausible, it could prove catastrophic to your investment portfolio. So what are the different 7 ways to lose money with bonds? Let's jump right into it. Number 1 is lack of liquidity. Now, do you recall last year when Detroit made all the headlines in regards to, it used to be one of the richest cities in the country, and it basically just declared bankruptcy? And well, do you think any of the bondholders could get rid of their bond holdings after that? Of course not. In 30 years ago, which is what's just crazy, even maybe 25 years ago, not many people in America would have ever bet that bonds issued by the city of Detroit would be tough to get rid of, let alone worthless or perhaps worthless. And people, even back then, and even just 10 years ago, were still buying very long-term Detroit bonds. And probably even just a few years ago, I don't have proof of that, but I bet they were. And they found out very quickly just how illiquid the wrong bond could be when things go bad. And that's just one example where bond liquidity dried up overnight. But this is a huge, huge issue. And now bond liquidity issues first begin with the fact that although the bond market is larger than the stock market in just terms of total absolute value, the bond market is far less liquid. There's just a fraction of the amount of bond traders and investors compared to stock traders and investors. And as we mentioned earlier, the other issue revolving around bond liquidity rears its ugly head during times of financial crisis, or really at any time that a certain city or a state or a municipality, etc., goes public with any kind of negative issues or whispers of a default. And if you aren't one of the first ones to know about it, in most cases you won't be, then the chances are good that you will be stuck with your bond to wait out the storm or possibly lose some or even all of your investment. Now, here's the best advice to keep in mind regarding bond liquidity. The smaller the issuer of the bond, the larger the liquidity risk of owning it. So choose wisely. Number 2 is interest rate fluctuations. Bond interest rate fluctuations are probably the most widely known risk to bond investors. And if you aren't as familiar with this concept, just remember that bond prices are inversely related to interest rates. Meaning when interest rates go up, bond prices, which is what you buy and sell them for, go down, and of course vice versa. So when we are sitting close to all-time low interest rates with really nowhere to go but up, as interest rates literally can't go too much lower before they start going negative, you can begin to understand why this fear is talked about so much in the press. Because when interest rates do finally go up, and yes, they will go up at some point, everything goes in cycles, this could start a bond crisis tsunami. Why? Well, can you imagine how scary it will be for many investors when they realize and wake up one morning that their bonds are worth much less than they were when they bought them just a little while ago? And it's very scary if and when the rates go up quickly, which will most likely cause a huge panic and could possibly even cause a bond bubble explosion. Now here's an example of what happens when interest rates do go up. When interest rates rise, the coupon rate, which is your interest rate payments on your bond, will lose value. Thus, the price that you could sell your bond goes down, as investors aren't going to pay that much for your bond unless you sell it at some kind of discount. Otherwise, they just simply go to the market and purchase a new bond, issue at today's better prices with higher interest rates, aka higher coupon rates. Now, the most important thing for bond owners to understand when it comes to this interest rate risk is a thing called duration. Duration is an equation that determines how the price of your bond will fluctuate with any interest rate change. And a bond's duration number is created by taking into consideration its maturity, its yield, its coupon, and its call features. And the higher a bond's duration, the more sensitive it is to interest rate adjustments. And let me give you an example. A bond with a 1-year duration only loses 1% in value if interest rates rise 1%, while a bond with a 10-year duration loses 10% in value if interest rates rise 1%. And even though it might be tough to envision today, we will see interest rates drastically higher than they are today at some point. It's just a matter of when, not if. Everything goes in cycles, and no economy in the world can sustain these kind of low interest rates forever, no matter how much monetary manipulation is going on behind the scenes. Number 3 is bond creditworthiness. Now, when most people think about the creditworthiness of a bond and how they could lose most or even all their money investing in bonds, they only seem to think about bankruptcy. However, it doesn't just take a bankruptcy to crush or eliminate bond prices. But before I get into that, let's talk about risk and reward in regards to bond creditworthiness really quickly. To begin, the yield, or aka your return, on any bond investment correlates with the overall creditworthiness of the entity issuing the bond. It's simple risk and return compensation structures that we're all familiar with. Where you take the most risk, you could possibly get the biggest return. And if you want no risk, you're going to get a very small return. For instance, you'll get the smallest yield on the safest and strongest issuer of bonds, such as the United States of America. On the other hand, you can get yields or returns hundreds of times more than a U.S. Treasury bond if you're willing to invest in low-grade junk bonds or very high-yield corporate bonds. However, of course, you're taking on the risk of losing some, if not everything, if you have invested in something where there is a default or a lot of negative publicity. Now, back to my first point in this section of losing it all. A default occurs when the bond issuer of your bond is no longer able to make interest or principal payments to you. Now, this can occur during a bankruptcy, as I mentioned earlier, but it can also occur if a credit rating agency downgrades the issuer. Huge price declines can also occur almost overnight if one of the credit agencies simply places the bond issuer on a credit watch status, which would normally happen well before bankruptcy talks even begin to emerge. So the takeaway here is to know your risk tolerance before you ever buy any bond. Don't just look at the yields that the bond will return, or your chances of getting burned by bonds goes up pretty big. Up next is inflation buster, and this is really inflation or even hyperinflation. And generally speaking, inflation normally does lead and means higher interest rates. And as you learned earlier, interest rates and bond prices are inversely related. Thus, higher inflation usually lends itself towards lower bond prices because of the higher interest rates. But inflation also has another dagger to throw at bonds. The other negative consequence of inflation, or even hyperinflation in some very rare cases, is negative purchasing power. In general, when inflation goes up, so does everything else in terms of buying power, your consumer prices and goods and services, etc. But of course, the one thing that's not going up is your bond investment, which doesn't calculate inflation into the equation. So if you have a bond paying you 4% over the next 4 years and inflation somehow goes up to 8%, you are actually negative 4%. In other words, your bond investment is now losing money in regards to true purchasing power. Now, there does exist a type of bond that protects you against inflation. They're called TIPS, or Treasury Inflation Protected Securities. And these are usually short-term bonds that have a hedge against inflation. But keep in mind that these can be very interest rate sensitive. So if we never experience any inflation, or even worse, we have deflation, these can actually hurt you as well. Now, the next one is reinvestment risk. Now, the economy and the stock market have been growing pretty consistently since 2009. And although we'd like to think that everything could keep moving up forever, history tells us otherwise. It probably won't happen. And in fact, 100% of every 5-year or longer bull market run has resulted in at least a 10% correction at some point. So once again, it's not a matter if the economy slows down at some point. It's a matter of when. And one of the consequences of a slowing economy is that interest rates can slow down as well. And when interest rates decline, bond investors are forced to reinvest their bond interest and any return of principal in some cases into new securities that will have lower rates of return. Of course, this will reduce the overall income that is being generated by your bond portfolio. The good news is that zero coupon bonds do not have this reinvestment risk because you aren't collecting payments throughout the term. But the big takeaway here in regards to this reinvestment risk is it's greatest for bonds with higher coupon or higher interest payments. And of course, this risk is only pertinent if interest rates go down, which is the opposite of most of the other bond risks that we're talking about here. Next up is bond fund Backfire. Another popular way to invest in bonds is to go into bond funds, just like mutual funds. In many cases, this is a great way to spread out the risk compared to buying individual bonds. However, bond funds still present some risk. Overall, bond mutual funds can experience the same kind of risk that we have covered so far, such as credit risk and inflation risk and creditworthiness, etc. But because the bond fund contains numerous individual bonds that are all expiring and held for different times and different purposes, these risks are usually pretty well spread out. However, it is that same bond fund design of having the different bonds expire, aka mature at different times to create different income streams for investors that really never end, perpetual, that can present some compounding problems down the road. Let me tell you what occurs. As the bond fund manager starts replacing bonds as they mature in a rising normal interest rate environment, which means bond prices are falling, the net asset value and the return on the bond fund fall as well. And although that might seem bad enough that the entire bond portfolio will lose some of its value, the real pain comes when investors all start leaving the fund in droves, which just happens in times of panic and just seems the way that people are wired these days. And when that happens, the bond fund manager is now forced to start unloading some of the bond holdings early to start meeting some of these redemptions, which can really hurt the overall bond fund, especially if the manager is forced to sell some of the highest yielding bonds first, and then of course having to replace them later with lower yielding bonds. The takeaway here is to always stay up to date and educated on what is going on within your bond fund. You do not want to be the last one to find out about a big shift or a sell-off or a run on the fund, if you will. You could wake up one day with an entirely different looking bond fund and a different risk tolerance than you originally hoped for. The last one here is just making bad bond assumptions. This final risk is kind of more or less a summary of all the risks so far, which is don't ever make the assumption that your bond or bond fund is free of risk and or just completely stable. Because when you hear about other people losing some or most or even all of their money in bonds, it's rarely the bond trader on Wall Street. Instead, it's the average trader out there, like many of us, with a day job that just made the false assumptions that their bonds and their bond income were safe and part of their safe portfolio and they never really need to be reviewed. And by the time you realize that there's any kind of big problem, it's too late, and it's too late to get rid of it. So don't be that investor. Don't chase just the yields, and of course, stay educated. Stay up to date on the latest bond news. Watch the interest rates like a hawk, and work with a financial professional that specializes in bonds. All right, earlier in the video I told you that I had a free report for you on this, and I do. You can quickly go right now to retirementthinktank.com/bond report. I have a dedicated page just for the people like you that have made it this far to watch this video, and you can instantly download the 7 ways to lose money with bonds report right now. It is there, it is live. Go to retirementthinktank.com/bond report and shoot me any replies or anything that you have in terms of other ideas or thoughts on this or things that we might have missed or questions that you have. We'd love to hear from you. Otherwise, enjoy your free report, and thanks for watching. And then last but certainly not least, all the disclaimers. This is not investment advice. We do not give investment advice. We do not make money off the sale of bonds or anything like that. This is simply education. There's not enough information in this presentation or the PDF report to make an educated decision. We highly recommend anyone and everyone work with a financial professional and someone who knows what they're talking about on bonds. We are simply an educational platform, and we do not give investment advice. So please do not construe any of this as investment advice.